All attendees are in listen-only mode.
Alrighty, hello everyone, and good afternoon or good morning, depending on where you're calling in today. Appreciate you signing in for our free education webinar with Chuck Austin from Florida Capital Advisors. He's going to be talking to us today about transaction financing readiness. So before I turn it over to Chuck today, a few housekeeping notes from me. First off, my name is Drew English. I'm the program coordinator here at the Exit Planning Institute. I will be on the call today to do a couple things. One, I am recording the webinar, and the recording of the call will be sent out later today. So just look for an email from myself with that downloadable link. Please click the link and choose to download and save. Therefore, you can listen to the clip in its entirety. Second reason why I'm on as well is to field questions, comments, anything along those lines over to Chuck throughout the presentation. You should have a questions box on the drop-down menu of your go-to webinar panel. We ask that you just type in your questions there. I will then make sure to read those over to Chuck at the end of the presentation to make sure we have some interaction, which we always prefer to have. So with that, I'll go ahead and just tee up Chuck here. Like I said, Chuck is from Florida Capital Advisors. He will be speaking at our national conference, the Summit, at the end of September in Nashville, Tennessee. If you want more information on either the Summit or what Chuck will be talking about, you can go to exitplanningconference.com, and you can see the venue, the speakers, the agenda, everything you need to know about the Summit. Or if you just want to contact me directly, you could either give our EPI Global Headquarters a call or shoot me an email. I'll be more happy to send over some information as well. So with that, Chuck, I'll turn it over to you, and we'll get going on today's webinar. So Chuck.
Great. Thank you, Drew, and good afternoon or good morning to everybody. I appreciate you taking the time to attend the webinar today. I'll have my contact information on the last slide of my presentation. So if you have questions that didn't get addressed today, or you want to have a follow-up conversation with respect to anything, or email me, you're able to do that, and I encourage it. I'm happy to have deeper conversations. So again, welcome. Let me go ahead and start by just a quick introduction myself. I've been a banker / corporate finance guy for coming up now on 38 years, actually. Most recently, raised capital and helped develop markets for Florida Capital Bank, one of the founding shareholders of a bank that still operates here in Florida. Took over running the bank in 2010 through 2014, which was kind of after all the smoldering stopped from the recession, and rebuilt and refocused the bank. So I've got operating experience in operating a privately held company in addition to being an advisor. In 2015, I formed Florida Capital Advisors. A little bit more about the bank. Mentioned it was founded in 2004. We're roughly 370 million in assets as of the last quarter. We're based in Jacksonville. I live in Orlando and travel around the state from here. We have offices in Tampa, Orlando, Jacksonville, and Gainesville. We are, and we're going to spend a fair amount of time talking about this today on the call, a national small business administration lender with preferred lender status, which means that we do not have to go to the SBA to get their permission to provide a guarantee. We've been at this now for 5 years. We've got a lot of experience with it and have the confidence of the SBA to be able to act on their behalf. We also do conventional lending within the state of Florida, primarily in the markets that I outlined there above. Real quick about Florida Capital Advisors, as I mentioned, was formed in 2015 as a division of the bank. We do have 2 certified exit planning advisors, of which I'm one of, and my partner Peter Allport went through the program a couple of years ago as well. And I also am a certified merger acquisition advisor. Put simply, we advise on and fund change of control transactions, minority shareholder buyouts, and business and real estate transactions, business acquisitions and real estate transactions. The premise for me starting Florida Capital Advisors, I went through the CEPA program in November of 2014. I looked at a lot of our clients, and they're all 50 and 60-year-olds, and they were less inclined to want to borrow money for growth per se, but were more interested in a transition opportunity or an exit strategy from their business and how we could help play a role in that. So that was the genesis of Florida Capital Advisors. Our targeted transactions, as I mentioned, are primarily management, family, or employee change of control transactions. The sweet spot for us are companies that have an enterprise value between 1 and 10 million. However, we've worked with companies larger than that, but we have a tendency to work with those companies that have somewhere between $500,000 and $1.5 million or so in adjusted EBITDA, which tends often to be below the threshold of private equity. We do provide financing for both business acquisitions by corporate buyers. So if you're working with a client that has another company that's interested in buying them, or an individual buyer, we finance both of those types of buyers. The typical transaction size for us ties into that enterprise value, is somewhere between $1 and $5 million in size. Real quick about why I think the SBA program that we'll get into really is a great vehicle to the extent that it lends itself to the valuation of the company that you're all working with. It's a much cheaper cost of capital of private equity. These loans have a tendency to get priced in the prime plus 2.25 to 275 range, floating. So, right now, somewhere in the, 7.25 to 7.75 type of range versus a 20% cost of capital if a company goes the private equity route. The other benefit is no outside involvement or influence over management. So they keep 100% of the company and keep 100% of the value growth in the company, and then also have some control over when they want to ultimately exit the company, whereas private equity, as I think most know, that they're operating on a 5 to 7 year time frame. So let me start with the challenges we see. I see as a planner, as a SEPA, as well as a banker, what challenges face shareholders in these buyout types of transactions. And there are no particular order here, but these are the biggies. The first is that the buyer, potential internal buyer, whether it's family or a minority shareholder or a key manager, just don't have the financial strength or personal assets in order to pull the transaction off. They oftentimes have trouble coming up with a down payment, or they just don't have the ability based on their stage of life to cobble together the money to do the transaction. That's generally the most pressing challenge. Followed by that is there's currently not a clear leader or successor in the company. I know as we have conversations and are advising our clients, really focusing on succession planning is important. It's important for a lot of reasons, but in particular, making sure that individual or individuals have been identified inside the company, have the resources to buy the company, have the desire to buy the company on the timeline that fits the owner's timeline. As you all go through the value acceleration process and identify risk points in the business that impact value, oftentimes those same risk points are going to impact the financing of the business as well. So a banker is going to look at it with a slightly different view than a value growth advisor, but there's a lot of intersection of assessing risk between the value accelerator advisor and the bank. We see this happen a lot. I'm sure you all do as well, that the business is just not going to be transferable when the owner's ready, due in large part to the relevance of that owner coupled with the other risk points in the business. We try to start with, and I know in our SEPA training, we look at both, a personal assessment and business assessment. We try to encourage the business owner to work with their wealth manager to determine they're going to be able to ultimately exit the business. I think everyone realizes that it's going to be a challenge to replicate the earnings and other benefits that the owner has from operating the company post a transaction. So we often start with the personal side before we even get real deep into the business side of things. We talk about triggering events, and this is discussed throughout our SEPA learning. Is we broke them down into the involuntary and voluntary. The most buy-sell agreements, if a company has one with multiple shareholders, and we've come across companies that do not, Most of the involuntary trigger events are captured within buy-sell agreements, and there's usually not much time to plan to address that trigger event. Where we like to get involved, and we as, whether we're a banker or advising in a value growth mode, is let's take a longer term planning horizon here. Let's make this a voluntary trigger event so that if any of those bullet points that are outlined here kind of strike what you want to accomplish, we've got the runway to be able to get the right result. The second point there, family or management seeking ownership, is one that we often come across, in addition to ready to diversify their net worth a little bit away from the business. So the value acceleration methodology that's taught through the SEPA program and we practice in our advisory practice really translates to setting the company up for being able to finance the owner's exit. It really pivots around de-risking the company and reducing the company's specific risk, which is going to lower the discount rate of the business, which is going to increase the value of the business and have a more desirable result for the business owner. But it's also going to increase the probability of financing the transaction on attractive terms, the seller financing being repaid, which is probably critical to the owner's ongoing lifestyle post a transition. And oftentimes in these acquisition or buyout transactions, there is a component of seller note that's in place for some percentage of the value of the company. And also it's going to sustain the cash flows before and after a transaction, which is key from the banker's perspective who funds that transaction. So I have used Mouse and a couple of other programs, VOP, and some of our own proprietary assessment tools to really go in and assess company-specific risk. Whether you use any of those tools that are out there or have your own, going in and addressing both these qualitative factors in the business really are critical. It's the same things that we look at as a lender into the transaction as well, especially when it's a change of control from an outsider. Is there a business plan, or is the new ownership created a strategic business plan that they're going to use to operate the company and as a filter for how the company moves forward? We look at the bench strength of the management team that's coming on or that is staying. We're looking at the sales team that built that company to where it is. What key things are in place to keep them engaged on a go-forward basis? Does the company have a well-documented process for bringing new customers in the door and moving it through the execution phase? Finance goes beyond just the quality of financials. Are they running their business with dashboard reports so they understand day in, day out how they're performing against their key performance indicators? But with that said, quality of financials and a simple piece of advice that you can give your clients is spend the money now to start getting better quality financial statements. From a banker's perspective, that's invaluable. From a value creation perspective, whether the company is going to sell internally or externally, that's invaluable as well. And then let's make sure also from a legal standpoint that we're not exposed there. If we've got a pending litigation issue or some other unresolved legal issue that can result in litigation, then that's going to be complicated for us to get involved with from a financing standpoint. So the value drivers that lower risk are really the same things that are going to make a transaction much more financeable from our perspective. The key ones I highlighted there or bolded in the top two bars. Got to have positive revenue and EBITDA trends. It's going to be difficult for us to finance a company that has choppy earnings. They're plus 1 year, down in the next, up marginally, break even, then on a growth spurt. That's a tough type of transaction for us to finance. I already touched on the quality of financials, very key to the bank or some other lender financing a transaction. So the value drivers to build value in the company that are outlined there are key drivers of lowering risk from a banker's perspective and making that transaction something that we would want to move forward with. So let me talk about a couple of the different options out there to finance an internal buyout. And again, this can be a buyout by existing shareholders, a non-ownership management team, family, or even a handful of key employees that have been with the company and have the aptitude to run the company going forward. So I'll touch first on conventional loans. So this would be a non-SBA type of loan. Typically, most banks are going to structure these deals not to exceed 5 to 7 years in repayment. Most, as you all know, most business value is concentrated in intangibles. Therefore, from a collateral standpoint, it's difficult to go much longer than 5 years. Some banks will stretch to 7, but in a lot of cases, these deals are even financed on 3 and 4 year type of buyouts. More flexibility with the conventional loans. You can finance a partial ownership buyout, which could be step 1 to a 100% change of control, or you can finance 100% change of control. So there is more flexibility from doing a couple different transactions with a conventional loan than there is with an SBA loan that I'll get into in a second. It's key that you advise your owners that they put if they're going to do a partial ownership transfer as part of a 100% change of control several years down the road, that a distribution policy needs to be put in place to provide sufficient cash to that buyer of stock, net of taxes, to be able to pay a loan back. Collateral coverage, I touched on that a second ago. It is important in addition to the cash flow. We're probably going to be looking for personal assets of the purchasing shareholder, because we're not going to be able to look at the assets of the business, since they're generally going to be in a minority position. And sometimes it's going to require the guarantee of the selling shareholder as well. We as a bank do not do conventional lending outside the state of Florida. We do, as I mentioned earlier in the presentation, do SBA lending on a nationwide basis. So with that, let me move into financing of a buyout with a 7A loan. The loan amount that the SBA allows for is up to $5 million. As recently as a few years ago, this was tapped out at $2 million. They moved the number up to 5 several years ago, which really opened up the universe for financing business acquisitions or shareholder buyouts with SBA financing. Contrasting that with the conventional loan, the maximum term here for a straight acquisition is 10 years. However, if there's a real estate component to the business, then there could be a blended amortization that could go beyond 10 years. The SBA allows for a 25-year amortization on real estate, 10-year amortization on business acquisition, working capital, certain equipment, and that type of thing. So if there are various components to the transaction, there may be the ability to extend that term beyond 10 years. As I mentioned, with the SBA program, and since most of these transactions, most of business value is in intangible assets, the bank gets comfortable with financing this because they receive a 75% guarantee from the SBA for the loan. So on a $1 million loan, the government provides a guarantee to the bank for 75%. The bank is then exposed if the company fails on that unguaranteed portion, which again, oftentimes is either not collateralized or under collateralized. Cash flow, a key underwriting metric here. Collateral secondary, cash flow is king. With that said, however, if there are personal assets of the buyer and it really is a fully intangible value type of transaction, there may be the requirement by the SBA for that buyer to pledge personal assets. The difference here is the selling shareholder is not required to guarantee the loan. Typically, in most of the capital structures on these types of transactions, the seller is providing some secondary financing. which can be on different terms than the SBA loan. It could be on less than 10 years, it could be 5 years, or even less than that if the cash flow allows for it. However, that seller note is going to be in a junior subordinated position behind the SBA loan. I'm not going to touch on all these in detail. I'll let you read from the screen, but I'll touch on the ones that are that oftentimes, get in the way of moving forward with the transaction. These transactions, unlike a conventional loan, have to be a 100% change in control. So it can be a minority shareholder buying out a majority or vice versa, but that it has to be a 100% change of control transaction. It can be multiple shareholders buying out a departing shareholder, but the new ownership team has to have 100% control of the company. There is a 10% equity contribution required from the buyer, and I will get into that in more detail in the next couple of slides. The seller cannot be active in the business past 1 year. It's critical as advisors that we impress this upon the business owner, that the personal planning is done, that they will have enough funds post a transaction that they don't need to be involved in the business in a paid capacity, either as a W-2 or a 1099 contract employee, because the SBA does not permit that activity in the business past 1 year. I already touched on the positive financial performance. Again, choppy earnings going to make it difficult to finance that transaction. It's important to, as you go through the value acceleration and valuation process, to have a level setting conversation with your client around what the value of the business most likely will be. At the end of the day, these transactions have to be supported by a business valuation performed by a certified business valuator with the appropriate credential. So if a business does not value add for what the purchase agreement is, then the transaction cannot get financed with SBA lending. So that's critical for the seller to have a realistic expectation and understanding of what value is. And then there's always a non-compete requirement that is executed as part of the transaction for a minimum of 5 years. We've experienced transactions where the seller wanted to have a 2-year non-compete, and from our perspective, too much risk, and from the SBA's perspective, too much risk. So these are the key points from a takeaway and I know we're going to have the slide deck on the EPI's website, but these would be the key points that you'd want to have in front of you as you're talking to a client about financing a transaction with an SBA loan. These points are also on our website at flcbadvisors.com. So let me talk a little bit more about buyer equity, and this would apply to whether a business acquisition, these next couple of slides, or a shareholder buyout. The seller cannot gift the equity injection to the buyer. If that was the case, the SBA would expect the purchase price to be reduced. So there needs to be some, as I mentioned, identification and planning to get cash into the hands of the internal buyers at least a year, ideally 1 to 2 years in advance of a transaction occurring. So of the 10% equity requirement, 5% can come from the buyer, 5% can come from the seller. However, if that's the structure of equity, then that seller note has to be on full standby for the entire life of the loan, meaning there can be no interest or principal payments for the entire time that the SBA loan is outstanding. That is different than the seller not providing equity and the secondary financing being in a subordinated position, but payments can be made so long as the cash flow is there. This doesn't come up very often. We want to see as a lender there be at least a 10% equity injection by the buyer, especially as you get into bigger transactions. We also like to see some liquidity from the buyer group in case that the company needs some subsequent equity injection down the road if projections are not being met, or there's some working capital issues, that type of thing. The seller can bonus an employee over a period of time Again, I think the appropriate period of time is at least a year in advance, longer if possible. So having that conversation, identifying that individual, and giving them the ability either through W-2 earnings or through buying into ownership and getting distributions is critical and part of a longer-term planning process. Key managers that may be buyers could use their accrued bonus for the equity contribution. So let me talk about a little deeper about equity and a business acquisition transaction. As I mentioned, the SBA mandates at least a 10% equity injection, and that was changed with the SOP change effective January 1 of 2018. Already touched on the buyer equity coming from seller and buyer. Again, typically not the type of structure we'd like to see. But what can occur is that buyer equity of 10% is against the total project cost. So it's the value of the business per the purchase agreement that has to be supported with a business valuation. And it also includes attorney's fees, any due diligence fees that the buyer expends, guarantee fees to the SBA, and other miscellaneous fees, appraisals for real estate, business valuations, things of that nature. So in this example, you have a company that's worth $3 million. The total project cost would be $3.1 million. The buyer in this case has to come up with $311,000. What I don't have in here, but is a permissible project cost, is some level of permanent working capital. So in the event that it was determined that there was a $50,000 in working capital that was needed once the company changed hands, or wasn't sufficient working capital delivered at closing, then the buyer of that business can include that in the total project cost, which would then increase the project cost, and would have to come up with the 10% equity of that transaction. Let me talk about some key requirements on a shareholder buyout. So in a shareholder buyout, you have maybe a minority shareholder buying out the majority shareholder. The buying shareholder, the minority shareholder, has to be active in the business in the last 24 months and have the same ownership for the last 24 months. They can increase the ownership that they have during the last 24 months, but cannot decrease the ownership. Another critical point on these buyout transactions is that the balance sheet for the most recent fiscal year, so for 2017 and the current quarter, so June 30, 18, must have a debt to worth ratio no greater than 9-to-1. So we cannot have a negative net worth situation in a balance sheet. We've had loans come our way, opportunities come our way, where essentially the equity in the company was a negative situation. That's just not going to qualify from an ownership transfer standpoint under SBA. In the event the two items above or not, or three items not above are, if they're not satisfied, then there has to be a 10% of equity piece put in by the buyer of the purchase price. So in other words, if you're buying out the shareholder for $500,000 for 50% interest, the buyer has to come up with $50,000 to accomplish that. And unlike the 5 and 5 seller and buyer note with a whole company transaction, that type of structure, whether the bank's interested in doing it or not, is not able to be done under a shareholder buyout type of transaction. So let me just summarize with some key takeaways here. I think I've said this several times throughout the presentation, and I know is constantly reinforced in the SEPA training as well, is starting a planning process well in advance of a trigger event. Don't be dealing with a client that's dealing with an involuntary trigger event. Have the conversations with them well in advance so that they can have a positive outcome. Really critical to identify and have conversations with those buyers. We found, and I'm sure you as advisors have as well, have found that business owners think they know they want to buy the business. They're making an assumption that individual wants to buy the business, and in reality, that individual doesn't have the risk tolerance, the capital, or the interest in being an owner. So if that's the case, good to know that, multiple years in advance as opposed to, 6 months before they want to exit the business. Begin to get cash into potential internal buyers' hands, whether that be through bonuses, whether that be through some other type of compensation program, well in advance of a sale. And the work that we're doing as SEPAs in de-risking the company is absolutely going to create value, but absolutely going to increase the probability of getting a transaction done by an internal buyer, or to the extent that the company decides to go external, that financing being accomplished by a third-party buyer. I'm going to go ahead and stop there, and I'll turn it back over to Drew for questions, and I'll put my contact information up on the screen if anyone wants to have a conversation offline. Thank you. Drew?
Thank you, Chuck. Appreciate that. We did have a few questions come in, so I'll just kind of read these off. And if you have any questions that people still want to ask, please go ahead and type those into the question box at this point. So first question for you here, Chuck. Have you ever seen the SBA underwriting process torpedo the deal based upon the SBA bureaucracy? What we recently witnessed, the SBA due diligence process was so inefficient and cumbersome, it prevented the deal from getting done. So how do you pick the right SBA lender to avoid such pitfalls?
That's a great question. And, the SBA is, keep in mind, a government agency, right? So bureaucracy and government have a tendency to go hand in hand. But at the end of the day, I think the answer to that question is you want to find a bank that is a preferred lender. That preferred lender has got the credibility and the confidence from the SBA to be able to sign on behalf of the SBA. Now, it doesn't mean they're not going to, if it's a transaction, and I had one that is somewhat out of bounds, we will, and other lenders, if they're smart, will consult with the SBA to make sure that they're in concurrence with our approach. The example that I had was the company, it was a divisional buyout of a company, and there was not audited financials for the division. That is an exception with SBA, and we sought their concurrence with our approach in moving forward with that transaction. So I think that the simple answer is to be dealing with a bank, a lender that has preferred lender status, number one, and number two, if your transaction has some twist to it, then I think most responsible lenders are going to go to the SBA, and then you're a little bit you bring in a time component to it if you do have to go direct to SBA on that.
Perfect, thank you. For those who have typed in about the PowerPoint presentation being available, it will be with the recording that I send out later today. So just look for an email from me with both of those attachments to it. Second question that came in, Chuck. How much time do I need planning and executing a sale to my management team, employees, or a family member?
Yeah, and I tried to touch on that a couple of times throughout the presentation, but I think it really is at a minimum a 1 to 2 year type of process, right? So if you don't have, you might not have the complete management team you need to run the company post you exiting it, and you might need to hire out that talent. That takes time. Again, the biggest issue we see is the identified buyers not having the capital to be able to do it. And so getting that capital into their hands, either through bonuses or other types of compensation, may take a couple of years to do that. So I think, ideally it's more than a year, probably closer to 2, to really do a good job and give the runway that's appropriate to have a good transaction.
Perfect. Another question that came in, will the SBA fund an ESOP?
I've heard that there has been ESOPs done through SBA. I think that is a cumbersome transaction. We don't do that. I know that's a half-baked answer, but I think that's kind of outside the normal course. But again, I've heard that those have been done, but we do not do SBA loans to fund ESOPs.
Next question. How are you charging your clients? Is it by hour, project, or success?
We charge our clients through project, and we're generally not engaging with the client to do a lot of value growth unless there is or other types of planning, exit transition planning, unless there is a transaction that's imminent, and we're planning towards that transaction. So while we're both CEPAs here and Florida Capital Advisors, we wanted that body of knowledge and that certification to go out there and be able to apply what's taught in that program to business owners that set them up for an internal financing transaction. So our focus is more on the transaction. At the end of the day, however, any planning fees we do charge, we do credit that towards some of the costs associated with obtaining the financing transaction.
Okay, and it looks like maybe the last question, but if there's more, obviously, we welcome that. Let's see here. If I'm a business owner and looking to sell to my management team in the next couple of years, when should I get the business valuation, now or later?
Well, I think, so one of the things we try to do is go in and give the company a range of value. I wouldn't get the certified valuation now, but I think working with someone like a SEPA or some other type of advisor that is versed in valuation, and then also as part of that valuation, going in and assessing the company and understanding what's hurting valuation is critical several years in advance. One, again, helps orient the seller about what value is, what can be done to build value, and will that value as it sits today be enough for them to exit in a couple of years? And so now they have some runway to be able to work on those things. So I'm not sure it's necessary to get a certified valuation now, but once we're ready to do the transaction and there's a purchase agreement in place and it's moving along, then I would say, probably 3 to 6 months in advance probably makes sense to get that done. But if you're going to do it, I would engage with your lender and have them be the one that orders that certified valuation, not the seller of the company.
Okay, perfect. Well, that's all the questions we had come in, Chuck. Is there anything else you would like to add before we wrap up today?
No, again, I just appreciate everybody's attendance. I encourage you, if you have a deal that you're currently advising a client on and you want to talk through specifics of that transaction, I'm happy to do that. I want to be here, a resource. As Drew mentioned, we're going to present at the conference. We'll go into more detail there. We're also talking about a member benefit for referrals that come in through CEPAs as well, which we'll talk more about at the summit in September. So with that, Drew, I'll hand it back to you. And again, thanks everyone for your attendance today.
Yeah, absolutely. And Chuck, thank you for spending some time with us and going through this. It was hopefully very beneficial for everyone that was online. Like I said a couple times, I will send out the recording and the presentation later today, so just look for an email from myself. And then like Chuck said as well, he'll be presenting at our conference in Nashville on September 24th and 25th. If you are not registered yet and still looking for information, please feel free to reach out to either myself or visit exitplanningconference.com for the venue, the speakers, the agenda, everything like that. But with that, we'll go ahead and conclude the webinar today and get everyone back into their busy Wednesdays and busy rest of the week. So Chuck, thank you again. And we'll all talk soon. Thanks, guys.
Great. Thank you.